When you think of investing, the first thing that comes into mind for many people is this complicated topic on the stock market. With so many numbers, figures, charts, it is easy to get overwhelmed by all this information out there and be confused. In this video, I'm going to break it all down and hopefully help make it more understandable for you. With that, let's go to my whiteboard. The stock market doesn't have to be confusing and overwhelming. Let's say that you own a company and you need more money to expand. Where do you get the money from? Well, one way is to sell part of your company to the public. To allow the general public to buy part of your company, you have to take your company public. This is called initial public offering or IPO. When you take your company public, the parts of your company that you make available to the public are called shares or stocks. So if you make 1,000 shares available, whenever a member of the public buys one share of your company, he or she technically owns 0.1% of your company and 0.1% of your company's profits. In a theoretical situation, if your company makes 10 million in revenue and has 1,000 shares, a stockholder who owns one share of your company will be entitled to $1,000 of the profits. I say technically because some companies choose to reinvest their profits back into their business, so the owner of the stock doesn't necessarily get 0.1% of the company's profits. However, when a company reinvests its profits back into its business, it helps the company grow. When the company grows and makes even more revenues and profits, the stock price of the company will rise. This is one way how the owner of the stock makes money and generates returns on his investment. When a stock rises in price over time, the stock is said to have made capital gains. This is one way how the owner of the stock makes money and generates returns on his investment. The other way is through dividends. When a company makes profits, it can make two choices. The first is to reinvest the money back into its business and earn its stockholders' capital gains. The other is to redistribute profits back to its stockholders through dividends. Whenever any of us are looking to buy a stock, we want to make more money and generate some returns on our investment. So stockholders like you and I will look at the potential capital gains and or dividends that a company can give us in return for investing in that company. So how do we determine which companies are likely to give us the greatest amount of capital gains and or dividends? One way that investors analyze companies to determine which companies can generate the biggest returns for them is to analyze the financial strength of these companies. To analyze the financial strength of the companies, investors will look at the financial statements of these companies. The three financial statements of companies are their balance sheet, income statement, and statement of cash flows. In a nutshell, the balance sheet of a company indicates the assets, liabilities, and capital of a company at a particular point in time. An income statement shows the company's revenue and profits during a particular period of time. And the statement of cash flow shows the amount of cash and other cash equivalents entering and leaving a company. By studying these financial statements, an investor can gain a greater insight into the financial strength of the company and can decide then whether to invest in the company or look for other financially stronger companies which can give greater potential returns. This covers an overview of the stock market and how to invest in stocks as a beginner. If you have liked this video and have learned about investing in stocks, hit the like and subscribe button. This will go a long way in helping this channel. If you want to learn more about how to read and use price charts in your investing and trading, click on the video on my left where I'll share with you how to use technical analysis. Click on the video and I'll see you there. To your financial success.